All right, thank you, Dave. Good morning to everybody, and well, actually, I take that back. Good afternoon to everybody. I see it's 12:03. My name's Richard Cheney, and I'm a certified SCORE mentor. I've been with SCORE for actually probably better part of a year, but I've spent with time with SCORE years ago before I retired for the second time, and I spent most of my career with the Small Business Development Center, which is part of the Small Business Administration. So. Um, I guess I hope that we'll get something out of today's work on financial analysis and producing financial plans. And so, with that said, we can get started here. So, if we are at the first slide, yeah, introduction to accounting. So, we use the phrase "accounting is the language of business" quite often because, indeed, businesses are based upon selling products or selling services, but ultimately, at the very bottom of it, at the very least, you're gathering data about the performance of your business in the form of transactions. Okay, so this is as the notes indicate, it's a standardized communication of financial information. It supports decision making, and this is really critical, not only for decision making on your part, but for decisions made by key investors or key people that you might work with, your suppliers and the like. So managers, investors, regulators, they all not necessarily going to look at the data, but they're going to look at the reports that are created by the data. So this data that you gather, it's transactions that take place daily from the first day you open your business until the day you close. And the way we manage the numbers really are based on what are the rules that have come out of the Financial Accounting Standards Board, otherwise known as FASB. Also, we are really aligning ourselves with generally accepted accounting principles, otherwise known as GAAP. Okay, so again, it's necessary for all managers. Yeah, go to the flow, indeed. So the transactions are recorded chronologically in journals. There used to be, they're still called the general journal and the general ledger. Now, these accounts, the accounts that are created in the general ledger, of which there are five: assets, liabilities, equity, or otherwise known as owner's equity, revenue, and expenses. These constitute just the five basic expenses you'll find in all general ledgers or in all businesses. Doesn't matter how small or large the business is, they have five. Your business has five accounting subject matters, and these are the five. Today, we're using electronic methods for managing these transactions, but prior to that, you would actually keep a general journal, which is chronologically kept, and as transactions take place, they would be recorded in the general journal as just like a diary, for example. Usually there'd be a date, there'd be a debit and a credit amount, which I'll come back to, and then an explanation. At the end of the day, at the end of the week, at the end of the month, but typically, usually at the end of each day, you would post those transactions to your ledger and they would be reorganized into these ledger accounts. So you could then produce reports going forward. And we'll get into those reports as we get there. One thing I should also mention just briefly, if you look at this organization of the assets, liabilities, equity, revenue, and expenses, they're actually organized always this way. For example, if you saw an account with a 100 number, like a 105 or a 125 or a 1015, that would be an asset account. Always starts with 100, 200s of liabilities, equity are 300, revenue 4, and expense 5. And they're organized in that way within your reports. One of which you won't see today, but there is a thing called a 10-column worksheet, which allows you to just take data from your general ledger and organize it so that you can actually produce an income statement and a balance sheet. And at the very least, we want to be seeing these reports periodically. So again, this is kind of an important aspect of your managing the data and creating the reports so you can evaluate the performance of your business. So let's go to the next one, the big three. Thank you very much. So again, this is pretty simple stuff. The income statement, shows a profit or loss over time. The balance sheet shows a financial position at a point in time, and the cash flow statement tracks cash inflows and cash outflows. So let's do go a little deeper here if we could. Well, actually, I wonder if it might be a good time right now. We'll come back to this. So the income statement is really the report that will indicate the amount of tax you owe, and it includes line items, operating expenses that are allowed to be tax deductible. So you'll see that when we actually look at just a brief example of a P&L, profit and loss, or sometimes known as income statement, or a pro forma, when we talk about projecting in the future, we'll see that it includes line items that are tax deductible. But on the cash flow, those line items will no longer be included because the cash flow deals only with cash coming in and cash going out. The other thing is the income statement shows a point in time, like the month ending or the week ending or the quarter ending. The balance sheet conversely shows the financial position of that business from the very, very beginning of that business. So, for example, if you happen to see a balance sheet for, well, I don't know if anybody remembers the A&P markets. A&P started years ago. That balance sheet would go all the way back to the very beginning. Whereas again, the income statement and the cash flow statement just shows periods in time. Okay. In addition, well, one more thing I'll say about that. Those statements, you can also add a number of other statements included in your financial model, such as amortization schedule, revenue projections, hiring projections, depreciation schedule. We'll look at that a little bit later. So on the income statement, also known as a pro forma for a startup, these are revenue minus your expenses will show your profit or loss. We do this on a monthly basis or sometimes on a weekly basis. We wanted to, again, include in this income statement, this pro forma, quite often we'll have attached to it or linked to it other schedules, like I mentioned before, I'd say an amortization schedule or depreciation schedule or revenue schedule. So, for example, if we could just go to the pro forma, and we could show that it's going to be at the end. Yep, just bear with me. Okay, here, if you can look at the pro forma and bear with me. Yep, okay. So on this pro forma, I don't know how well you can see this, but I've italicized and put in bold line items that are changing from period to period. So the large box on the left, you'll see it's years 1, 2, and 3, gross revenue at the top, then expenses below. So for example, if you drop down and you look at depreciation, it's in bold. Right there, it's $1,500 for year 1, and then in year 2, it's $2,500, and in year 3, it's $3,500. And we'll show that later on when we look at the depreciation schedule as to how that is calculated. But this report is simply a pro forma. It's an income statement or a P&L, but it's projection into the future. These are actual numbers from a client I worked with years ago. He's actually started a surveying company, and these were his original numbers we submitted to a lender for a small loan. And what we did in italicized and bold, we just show the changes. If it's not italicized and bold, then it's really just fixed. So for example, if you look at the state LLC registration, this is Massachusetts, it's $500 to start, and it's $500 every year. There's no change on that. If you look at the little box to the right-hand side where it just says expenses year 1 and year 2, this is referred to often as the common size statement, and it aids in the comparison and efficiency of these operating expenses. And simply put, if you look at the amount in year 1, let's say, and these, if you look all the way to the left, you'll see for example, insurance, professional liability, insurance, general liability. And we see that these are very small, really, these are because of we didn't go to two decimal places, but it shows the relative mix of operating expenses as a part of the total amount. So, for example, if you look down to the field help, this is interesting because he's adding people in year 1, 2, and 3, and going across his field help was 38.1% in year 1 of total expenses. In year 2, it's up to 39.4%, and you see the increase. This would tell you right off the top, you look at this in a very simple, brief manner, you can determine that in this case, there are very few minimal changes in this particular common size statement. But if you saw a large adjustment, large changes from one year to the next, and you don't know why, then this would bring your attention to where you needed to ask the question, and more importantly, answer the question, why were the changes so dramatic? And the same thing is true just on the pro forma before. And if there are changes, you should be able to understand why are those changes happening. And there are other things that are going to be taking place here that we haven't seen yet. And if we could go also to the depreciation schedule right now might be a good idea, just so I can, I think, where is it? That's the cash flow. Keep going. To depreciation. So just depreciation. I just want to bring this attention to this. We'll come back to this, but here I just wanted to show you on this depreciation schedule. It shows the purchase price, the useful life of an item, of an asset, its salvage value, which is what it would be worth from an accounting standpoint, not a marketing standpoint, at the end of its useful life. And then the amount we depreciate, and this is a straight line depreciation. I'll come back to straight line versus another form. But we noticed that here we have what is called a GPS. It's purchased in year 2. And if we, I don't know if we want to go back, but the amount of depreciation changed from year 1 to 2 to 3 because we added this purchasing a GPS system in the middle. Actually, I think it was in the 6th month of year 2, right in the middle of the year, and that showed again the added depreciation of $2,000. You don't use a depreciation schedule if you don't have depreciable assets, but if you do have depreciation, you definitely want to include this on your pro forma or income statement, because those assets are depreciable. If we can go back to the pro forma one last time, and that would be very helpful. Again, I just want to show the pro forma there. This is the income statement pro forma. If you look down under depreciation, there's debt, and this is interest only. This is a depreciable. That's not an asset, but it's the amount is it can lower your taxable income. So it's just the interest on their amortization schedule, not the principal. And we come back to the balance sheet, you'll see that it's principal and interest. Or actually on the cash flow too, it's principal and interest. But here we're just showing not principal, just the interest only. Okay, I think we can go on to the balance sheet now. And so we'll make a few comments about the balance. Next, there we go, the balance sheet. And we'll probably want to take a look at the balance sheet as well. This is, again, assets, liabilities, and owner's equity. It follows what is called the fundamental accounting equation, which is assets equal liabilities plus owner's equity. When we calculate assets, when we calculate liabilities and owner's equity, we do that independently of one another. Some very smart person could say, well, look, if I know what liabilities are and owner's equity, I can back into the value of my assets. And we don't want to do that. We want to find the value of each one of these independently. Then we plug it into the equation and we want to prove the equation. So another way to look at this is if we take assets, we subtract liabilities, that's got to give us owner's equity. Well, yes, that's true. But generally speaking, we want to calculate them independently, and then we'll make sure that we're doing this accurately. That goes back to the idea, when we are managing the transactions of this business from day to day, we want to manage them properly, and we want to make sure at the end of each reporting period, if we say weekly or daily or monthly, however you want to do it, we would certainly recommend minimally weekly. You add up your debits and you add up your credits, assuming we're going to use a double entry system, which is preferable to a single entry. We'll come to that in a minute or two. that when you add up debits and credits, they equal one another. If they don't, if the debit entries and the credit entries at the end of a reporting period are not equal, there's a mistake somewhere. It could be a mathematical or arithmetic mistake, or it could be a simple posting error. So, for example, if you could have an operating expense called business, I'll say um, business expenses or then business furniture. Like, because in other words, you can have one operating expense that keeps track of paper and pens and pencils. You can have another operating expense that keeps track of your business furniture, like if you have chairs or sofas. You could easily make a post to one versus the other, and so that's one of the ways one of the things we want to keep a track as we go forward. All right, so again, it's a snapshot, specific point in time, and it reflects then the cumulative results of operations. So here, then, if we could go to the balance sheet real briefly, just take a look at that. Um, all right, that's the cash flow, and one more, I think. That's there we go, the balance sheet. Here we go. So again, you'll see assets, and they're listed in their order of liquidity. So cash always comes first. And then after that, whatever is most liquid, then to least liquid. So we see here accounts receivable. Here's a situation where you have a client who, let's say you did some business for them, you charged them $500, they paid you $250, so now they owe you $250. And you'll show that here as, again, a receivable. And then before that, the robot, the prisms and rod, and then the GPS, these are assets used to run the business. And then below that is a depreciation. Now, I will show you, this is accumulated depreciation. This is an interesting account because it is a contra asset account. It's the only asset account that is negative. And so what we do here is we accumulate depreciation over time. We don't we take depreciation this year, which would say 12,000. Well, I'm sorry, 1,500, and then we added the GPS in year two. We came up with another 3,500 of depreciation. Now it's 4,000. And then up to 7,500, where we're just accumulating depreciation over time. And as we get to the end of the useful life of an asset, let's say in this case 5 years, so it would be in year 5, it would show that the total value of assets would be equal to the total accumulated depreciation, which means that the asset value on the balance sheet is zero. It doesn't mean that the asset value is zero in the marketplace. Let's say you bought a copier and it has a zero salvage value from an accounting standpoint. You could sell that the copying machine for who knows, $1,000, $2,000, $5,000. So that would be a cash that comes back to the business. But from an accounting standpoint, the depreciation, it's fully depreciated. When you purchase a business, as an aside, and it has fully depreciated assets, you can go back to the very beginning and re-depreciate those assets. So one thing to keep in mind. Let's go back to the balance sheet slide, and yep. But we're going to go on to the cash. But one last thing about the balance sheet I want to mention is when we look at accounts receivable and accounts payable. Well, actually, I think we cover those in a minute. So let's see. We want to do is we do a macro or a micro report on receivables or payables. Basically, what it means is receivables, money that is owed to you. Payables, that's money that you owe. And those will show up on your balance sheet. They don't show up on your income statement or pro forma or your cash flow. All right, I guess let's move on to the cash flow statement if we could. And I got to make some comments about cash flow, and then we'll go look at the actual cash flow statement. One of the things I should point out, and I make this comment with all of the clients I work with, at least in the very, if not the first meeting, but certainly by the second, there are two reasons why businesses fail. And of the two, the most the one that really pops off the sheet at me is undercapitalization. And where people make the mistake always is they undercapitalize their business. So we look at the very beginning of a business, we'll create a source and use statement. We'll show that in a minute, but not right now. And we look at, well, we have to buy this, we have to buy this, and so on. And we never take into consideration working capital. Your business can operate at a loss provided there is adequate working capital. The working capital allows you to operate at a loss this month with the understanding that in month 2 or 9 or 12 or 14 or whenever that you'll begin to now have positive cash flow. So the key here is you have to have adequate working capital to get from the point where you're not making a profit in month 1, 2, 3, or 4, but you are anticipating profit in future months, and the working capital will get you from that point, the beginning of the business to the end. So we're looking at the timing of inflows and the timing of outflows on this. It's focusing only on cash movement. Okay, so this is actually used very nicely for the timing of large purchases. So if we could go to the cash flow, which would be very helpful. Okay. That's there we go. The cash flow here, what we're looking at, these are just the months in year 1. So we went from March to August on just on cash alone. So again, what shows basically pretty much all of the operating expenses that you'll see on your pro forma or your income statement, except that here it doesn't show depreciation, you'll notice. And number 2, the debt includes principal and interest payment because, again, that's a cash payment. So we're just looking at cash going in and cash going out, the timing. So, for example, we're showing here that on your professional liability insurance, we're making a payment of $1,000 in April and then a payment of $625 in July. But in March, May, and June, and August, there are no payments. And so what this tells you is that, well, I need to anticipate the need to for maybe a large cash outlay coming up. For if you go a little farther down, you'll see website. There is no payment until June, and that's $1,000. So you could take the $1,000 and divide it by 6 and make equal payments every month, or you make the one large payment in the middle of the year, in this case, June. Quite often, we're finding that insurance will be paying quarterly. You might find that, just again, going back to insurance, if I pay it annually, I might get a discount rather than pay it monthly. And so what this chart shows, it's just simply the flow of money coming in and the flow of money going out, and how that might change from month to month, depending upon the performance of the business. It doesn't show this here, but with the cash flow allows you to not only analyze, anticipating large inflows or large outflows of money. It also, say in this particular case, we use this to make a decision about buying that GPS. Again, that GPS was, I think, I forget how much what it costs, but we don't include it on the cash flow. We could have. We could say to ourselves, well, by the time we get to July, it's going to have beginning cash of $51,579. That's more than enough to make up to buy that particular GPS unit that the person bought. If you don't use cash from your business, where else will you go? Well, you can go into your personal pocket, or you could go to a bank, borrow money, might take out a HELOC. There's a number of ways where you could look to secure the funds to make a major purchase, or you simply look at the cash flow of your business and determine, well, this would make perfect sense. Let's use the cash from the business. Now, if we can stop here just for a second and just kind of summarize, you couldn't do any of this unless you actually captured the data that happens. And by capturing the data, going back into the general journal and the general ledger, and it is something that is not nearly as daunting as it may sound. But if you don't do this, and you come to a SCORE mentor, and the SCORE mentor says, well, what's your cash on hand? You'd be well, you might be able to say my cash on hand. Yeah, because I keep a checkbook and I might be doing a single entry system. I could tell you that, but you can't produce a balance sheet on a single entry system. So you capturing the data, it just kind of reinforces, at least in my mind, the importance of capturing data so you can produce a report like this. To me, I'll just say one last thing about cash flow before we go on. Cash flow by far is the most important report you can produce in order to effectively run your business. If you want to determine as early on as possible the health and well-being of a business, it's through the cash flow reporting that makes all the sense to me. It's not through the income statement necessarily, because that doesn't show you whether or not the business can operate and has adequate working capital. And the balance sheet doesn't tell you that. All it tells you is well, the value of the assets, whether the business has any liability. The liabilities could be in the form of owing the bank money or owing an investor money. And then, of course, the owner's equity would be your original, what's called original paid in capital. That's the money the owner takes from his pocket or her pocket and puts into his business account to start the business. Those are important reports, but the cash flow is the critical report, at least in my opinion. We can move on to the accounting process. But there we go. Oh, there. That's it. So again, I mentioned before that this is the accounting process starts with recording transactions in the journal, then we post to the general ledger, and then we prepare the financial statements. This is done electronically today, but it wasn't that long ago when QuickBooks, which was then called, I think, Quicken, and there was also Peachtree, I believe, and there was another one that have gone away. But before these electronic accounting systems were developed, I mean, we literally did things through the general journal and the general ledger. And what that allows you to do, or requires you to do, is really come to grips with the difference between debits and credits. I really, I'm not going to go into the detail about debits and credits today, because that's a full workshop or a webinar in and of itself. When you look at assets, for example, a debit does one thing to an asset account and a credit does another thing. So, for example, you would naturally assume that if I received an increase in my asset, then of course I would credit that asset. And if I received something that reduces the value of that asset, it would be I would debit that asset. Well, as a matter of fact, it's the opposite. You would debit an asset you increase an asset by debiting, and you decrease an asset by crediting. And don't ask me why, but that's how the system works. So it does require some understanding of debits and credits, but with an electronic system, I believe that you will post automatically from the journal to the ledger, but you still should have an understanding of the value, the reason why we use debits and credits. Okay.
I'm going to jump in for a quick second and just say,
Yes.
we do have on April 9th at noon, there is a webinar on QuickBooks, which
Ah,
does all of this electronically with Elizabeth Santos. So if you'd like to register for one of those webinars, you can go to score.org, and that will be listed there, April 9th at noon. The other thing is, I think David was piping up. We've got a couple of questions from chat on the last few slides. David, do you have those?
This is a good
Yes.
time to stop. Yeah.
Thank you, Ian. Thank you, Rich. Jamie Brunson asked, on your balance sheet, can you list working capital as a separate cash line item?
I'll answer that question. Since I am not an accountant by trade, there's two ways I'll answer that. One, I've never seen it done that way. Working capital is simply cash. I guess the question I would pose back is, why would you want to do that? But again, there's no reason why you couldn't, as long as you understand that working capital is cash and cash is cash. So there'd be some reason why you want to denote the two on a balance sheet. I don't see any reason there. I don't know of any generally accepted accounting principle that would preclude doing that. But I suppose if there is a reason, sure.
Okay, thank you.
Yeah.
Another question from Annie Tallchief was, is there a general way to look up when items depreciate? I think she's looking for depreciable life.
Well, I was actually, I think I'm wondering in my notes, do we go back to the depreciation schedule? I don't know if we do. Oh, actually, yeah, when we do it, we show depreciation. We'll do it right now. Okay. So this is straight line depreciation. So I don't want to get ahead of myself. So I don't know if you want to ask the question one more time so I can do it, make sure I get it right.
Yes. Annie asked, is there a general way to look up when items depreciate? I think she's talking about depreciable life.
Yeah. So when we look at this here, the purchase price, that is something you would discover on your own as an owner. You would go out and purchase here these items. That's what they cost. The useful life and the salvage value, these are generally they're found generally in the Financial Accounting Standards Board or under generally accepted accounting principles. There is a section on depreciation, and the assets are generally listed as to what a useful life might be, and an asset category. They're not. I don't believe they're very specific, but they're asset categories, such as, again, maybe something that has to do with presses, like a printing press, or tools, or some other demarcation. But they list them in categories, and within those categories, they give, again, part of the generally accepted accounting principles. This is the useful life of this particular category, and the salvage value and usually it's not a dollar amount on salvage value, but might be a percentage. And again, it's an accounting term, not a marketing term. That's one thing that you need to be very clear on. So we say if the robot was purchased at $5,000 and it's valued at $500 at the end of its 5-year useful life, you might say, well, no, I could sell this for $1,200. Well, there you go. Then it's not worth $500. It's worth $1,200 or a $700 difference. So you get the issue of the useful life and the salvage value, usually from a source that's from FASB or from GAAP. And by the way, we'll come back to this later on, but we use straight line here, and there's another form. There's another form called accelerated depreciation, which I'll come back to, which is the one we'd use most often. But in this particular case, on this particular model, and this was not the final. This model was eventually submitted to a lender for lending purposes, and we actually went to we changed it from straight line to accelerated. But I didn't want to include that because it gets a little more complicated. But I don't know if this answers your question.
And then just in the interest of time, David, maybe one more question and then we can save the rest for the end.
Yep.
Okay. Jamie Brunson asked earlier, how do you tabulate owner's equity independently?
Well, that's a very good question, and it goes back to the capturing data in the general journal and then posting to the general ledger. Every time, again, using the double entry accounting system, there'll be a debit entry and a credit entry. As every time a transaction takes place, you're going to analyze that. Well, you or QuickBooks will analyze that transaction. So there might be, let's say I sold watermelon, for $100, and so I received $100 and I sold $100 worth of watermelon. Okay, well in that case, your watermelon, your assets, your inventory. That's an asset category, is going to be reduced by $100, and your revenue category is going to be increased by $100. Well, and then as you gather these transactions, if you have a transaction that has direct impact on your owner's equity, then you're going to credit or debit your owner's equity account accordingly. Now, at the end of the day, when you start creating a report, you'll add these amounts up, and then you receive here's the owner's equity amount, here's the liability, here's what I owe the bank. In other words, as I pay the bank down and I no longer have the same amount of principal I owe, that usually that money goes directly to the owner's equity account. So it depends on how you're managing those transactions. So in other words, what you don't do is you don't say, well, here's my assets, here are my liabilities. I'll subtract liabilities from assets and back into my owner's equity. You do that to double check and make sure you added them up properly when you post. And so when you capture in the journal and you post to the ledger, that's where you ensure the data is done properly, and then you could calculate each category to based upon the what you posted and what you've captured in the journal. Again, I hope that answered that. So we are at the accounting process. Let's move on to the accounting tasks. Next page. So again, this kind of it does sound a little daunting, but once you're using, a QuickBooks program, and you do have a basic understanding of how it works, then it's very, very easy to produce your daily cash account, your bank balances, your receipts on a weekly basis, accounts receivable, accounts payable, what you're owing payroll taxes. As a matter of fact, you will most likely do payroll in-house at least in the beginning, because the business is relatively small. You don't need to go outside and pay somebody to do it until you begin to hire, multiple staff members and employees and the like. A monthly, again, you would do financial statements and financial reconciliations. So again, the reports that I'm referring to, I'm not talking about the amortization schedule, depreciation, those. I'm talking specifically about there's three reports: the income statement, the balance sheet, and the cash flow statement. Those are the three. And again, most important to my opinion is the cash flow. That's something you would do at the very least monthly. And I would probably recommend doing at least the cash flow on a weekly basis, unless the business is not a big cash business. You can make some assessments of your own as your business grows, and so on as it gets bigger. But at the very least monthly, so you really have a handle on what's going on with your business. And the mix in your, as your operating expenses, are they increasing? And it's so, are they increasing because you're increasing your business? I'm selling more products, or therefore my inventory grows. Therefore, I'm adding more employees. So it stands to reason, yes, my requirements to pay federal unemployment tax, FICA, state unemployment tax, those would increase as well. Well, if you see them increasing, but what seems to be at an inappropriate rate, that brings to your attention a problem that may occur. You would never see that if you didn't produce these reports. And again, the reports are not hard. I mean, literally, you can press a button and the reports come out. Maybe not that quite easy, but pretty close. So again, you really want to produce these reports. And one last comment about the accounts payable and accounts receivable, particularly on accounts receivable. You want to produce aging reports on receivables if you have a list of clients that are paying you over time. In this particular case, I was showing you these reports. They did not have clients doing that, but in some cases, you have people paying you in 30 days, 60 days, 90 days. You got to be very, very careful. If a accounts receivable amount on your balance sheet goes out, say, past 90 days, according to the generally accepted accounting principles, I think the number is less than 80%. Less than 20% of that amount will be collected. In other words, 80% will not be collected. So if you've got to say $1,000 that's out over 90 days due, it's assumed that you won't get that $1,000 back. So it's important to do these daily or periodic reports. When I go to we're on page, we want to move on if we can to the next, I mentioned before, double entry accounting uses debits and credits. Again, almost all businesses are using debits and credits as opposed to a single entry system. And again, the reason why we do it, it's It's because of accuracy and self-checking. The singles entry system is somewhat limited. It's simple to use, but you can't produce a balance sheet with it. And so again, we're focusing again on assets, liabilities, and owner's equity, and revenue and expenses. If you go to the next one, cash versus accrual, again, this is something we can spend very little time on. The accrual records income and expenses when it's occurred. So in other words, again, going back to accounts receivable, you had a transaction where you gave somebody $100 worth of watermelon, they gave you $50, but actually you accrue, it's $100 you accrue, and with $50 in accounts receivable. The cash records only when the money changes hands. All right. So the accrual provides a clear, certainly a much clearer picture, financial picture of the business and how it's running. You want to go on to the depreciation and cash flow? Okay. I really don't have to go back to the cash flow statement here, but I wanted to bring to your attention this thing called makers. So again, it allocates asset cost over time. It's a non-cash add expense added back to your cash flow. And the common methods include straight line and MARCS. It's not important necessarily, but I just have to remember it's modified asset cost recovery schedule or system. I'm not sure if it's system or schedule. Modified asset cost recovery. Why would we use that versus straight line? With makers, it's an accelerated depreciation schedule. You get to use the total amount of depreciation doesn't change, but the timing of it. So instead of having straight line, let's say $100 per month over 3 years, you could have $200 in month one, and then say $50 in the next few months. You can accelerate it in the early stages of the business. Why would you want to do that? Well, the more depreciation you have, which is non-cash expense, remember, you're not writing a check, it lowers your taxable income. It's tax deductible on your income statement or pro forma or P&L. All right. So by using a non-cash expense, you're actually putting cash back into your pocket. And in the later years or later months of the useful life of the asset, you're showing less depreciation, but by that time the business has grown and become more profitable. Hopefully, we can move on to the next page. Okay. So real briefly, other reports, break-even analysis. You want to know how many widgets do I have to sell before I'm going to make a profit? Well, fixed costs plus variable costs. These you needed to, here's your sales, you minus the fixed costs, minus sales costs, and so on. That's obviously your pricing structure and cost structure are going to affect when you might break even. Cash flow forecasting, plan for short-term cash needs. As I mentioned before, when this person was buying the GPS in my client's business, we used the cash flow to determine, are we going to buy it from cash flow or someplace else? By doing cash flow forecasting, you'll identify surplus or shortage periods. That's a very important issue to come on, and it's really critical for determining how stable your business is. So cash flow forecasting really is used to determine, do I have adequate working capital on hand, and will I have adequate cash on hand if I want to make an asset purchase at some point in the future. If you want to turn to the next one, if I can. Okay. As I mentioned before about aging, you have macro aging groups, receivable by age. So again, 30-day, 60-day, 90-day. You might have heard of a phrase sometimes like 210 net 30. That's a phrase sometimes we use in business. And it could be 210 net 30. It could be 315 net 45. But what it simply means is 210 net 30. Pay me within 10 days of the invoice, I'll give you a 2% discount. Otherwise, it's due within 30 days. So why would we do this? Well, it encourages prompt payment. And if you've heard of the phrase, I believe, float, and a lot of businesses, a lot of large banks use the concept of float. The earlier you get money in, the sooner you can actually put that cash into an interest-bearing account. Not a laddered CD necessarily, but something that might pay a small amount of interest. So if somebody owes you $500, you don't want to wait 90 days to get that $500. You'd like to get that $500 as early as possible. And one last comment about age reports and accounts receivable. If you were to go sell your business, well, one way to determine the value of your business is we look at cash flow, and then we also look at the value of your balance sheet. We look at the value of your assets. Well, if you have, let's say, $5,000 of accounts receivable, 3,000 of which are 90 days, they're going to discount that by 80%. So whatever the 90-day amount is, it's going to be reduced dramatically because they don't expect you to receive that. So the your adjusted assets on your balance sheet will be as a result of having your aging report going out past 60, 90, 120 days. Same thing is true on accounts payable. You want to keep track of your accounts payable. Micro aging focuses on individual customers. Macro aging is receivables by age. Again, it talks about collectiveness. And then there's ratio analysis, which we certainly want to get into at some point. Before I go any farther, I just want to mention real quickly, ratio analysis, it's used, compares your firm's performance over time. So you can compare your performance of your business today and your business tomorrow and the next day, or you can compare the performance of your business against other businesses. How do you do that? It's benchmarked by industry standards. You've all heard of the SIC code, Standard Industrial Classification, SIC. It's now changed to what's called NAICS, NAICS, North American Industrial Classification System. Same thing as a SIC code. Every business is categorized within these, I believe, they used to be a 6-digit code. It could be 9-digit, I'm not sure. But you have all these codes. So you can take your business located in a particular part of the country and a particular size, compare your performance against other businesses. So we're going to just mention real briefly here before we end some ratios that we can produce. But we use those ratios to compare the performance of our business against the last year and the year before, or against the competitor down the street. You're opening up a cafe, sell coffee. We're working on that right now. There's Dunkin', well, it used to be Dunkin' Donuts, now it's Dunkin' Go right down the street. There's Starbucks down the street, and so there's McDonald's down the street that sells coffee. How are we? Well, you don't really necessarily compare yourself to McDonald's. How are we doing against these other cafes? So we would want to get this information. You can find them from the RMA annual statements. Actually they used to stand for Robert Morris and Associates. I'm not sure what it stands for now, but RMA and Dun & Bradstreet will have all that information. We can move on here. So I think we're getting near the end. Yeah. So other helpful financial analysis reports. There is liquidity and activity ratios, debt and profitability ratios. Basically the four: liquidity, activity, debt, profitability. So for example, on a liquidity, you might be looking at a current ratio, which is, say, current assets divided by current liabilities. Or you might be looking at a quick ratio, which is very similar to a current ratio. But in this case, we take your current assets, we subtract out inventory, which may not be that liquid, and then we divide by current liabilities. So one's current, one's quick. That's what you named. A 1 or less would not be a very good sign. Inventory turnover, activity, it's cost of goods sold divided by inventory. It basically tells you how fast are you turning inventory. An inventory turnover ratio of 12 means you're turning it over every month. If you look at a debt ratio, it's total liabilities divided by total assets. That will give you a debt ratio. Yeah, if you have a low one, that shows conservative use of debt money. On your profitability, you might look at your net profit after tax divided by your total assets. That would give you your return on, say, you can do return on assets, return on investments, and so on. There are lots and lots of ratios. You can't produce a ratio unless you capture the data. Again, I don't want to sound like a broken record, but you can't do one without the other. And I would like, if I could at this point, and if you go right near the end, I want to show the source and use statement. It should be right near the end here. I want to bring to your attention the source and use. Nope, 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 nope. Should be. You don't have a source and use. Oh, wait a minute. No. No. No, that's
I
not it.
don't recall putting a
Okay,
source
maybe you didn't.
at the end.
Oh, well, that's it. That's it. Well, that's the
Okay.
one I want. That's
Okay.
yeah. This is a source and use statement. In this particular case, it's almost okay. What I want to bring to your attention is on your lower right-hand side, it says coverage ratio 17. This type of ratio, it's one of the things a bank looks at immediately. You want to borrow money from a bank. The biggest question they have is, are you going to be capable of paying this back? Is your business going to, in this case, is your business going to be able to pay it back? So on the left-hand side, at the very top, well, actually, go down. It says use. We bought business supplies, office supplies, robot, and so on and so forth. He spent $19,000 of startup, including $10,000 of working capital. So where does that money come from? He put down $3,000 of his own, all right, and took a bank loan of $16,000. That adds up to the $19,000. Okay. If you look over to the coverage ratio, we look at the pro forma, we looked at depreciation, amortization, all that. We take his net profit before interest and depreciation. We add back interest and depreciation. We divide that by his total profit, I'm sorry, his principal and interest payment, and we get a factor of 17. What that means simply is, think of it this way: if you had a coverage ratio of 1, that means all of the income you made after you paid all of your expenses, after you paid all your taxes, you would have just enough money to pay the principal and interest to the bank. That's not a good coverage ratio. A coverage ratio above 3 or 4 is considered to be excellent. In this case, 17, the bank couldn't give this guy money fast enough. It was only asking for $16,000, very small amount. But this is exactly the type of ratio or of analysis we would do on an existing bit when you want to borrow money. And you could take these numbers and add zeros to them. It doesn't really matter. But the coverage ratio is a critical piece for for bankers when they're looking at whether or not they're going to be willing to loan you money, and without going into the 6 C's of borrowing. So that really does it for me at this point. Again, the analysis helps you to monitor not only the current health, but the future health of your business. You do it. I'm, if you haven't gotten the impression, I'm kind of really big on financial analysis. So I say do it daily. But really don't let it go beyond weekly, certainly not monthly. And you can certainly get help from SCORE mentors to do this work with you. We won't actually do it for you, but we'll show you how to do it. We're near the end. I don't know if we have time for questions, but
Rich, I have one question from Janice Krish, and she asked, can you point out key places to analyze on the cash flow and other statements to determine if a business is ready to expand or not? So key places to analyze on the cash flow or other statements to determine if a business can expand.
I would say you certainly would start using your financial reports, primarily cash flow. But I would actually link that back to your marketing plan, what's going on within the marketplace, your competitive set, uh, without calculating, current market share, where you want to go in terms of how much of the marketplace you want, what kind of competitive um, uh, um, features does your business have over competitors. Some of these other factors would play a role. I don't think you can ascertain an answer to that particular question strictly from financial reports, but you certainly couldn't, I think, evaluate a potential answer without having the financial data in front of you. I think you would need a little more than just what's in front of you, but at the very least, you would need to start with a cash flow statement.
Sal
And everything.
Rosenberg suggested that she use SWOT analysis to
Well,
come
by
up.
all means, strength. Yes, we do that all the time. Look at the opportunity. The strengths of your competition. They threaten you, but their weaknesses. That's where your opportunities are. You could identify a new market niche. Maybe you could introduce. I'm opening up a new product line that I'm not used to. I would have to add inventory. I may have to add sales force. I may have to add some more assets. But also on the other hand, I would increase my revenue by 2 or 3 times. Would it make sense? It could make all the sense in the world, certainly. But that's exactly the type of thing you would do when you run your business, if you want to grow your business or maintain your business.
And last question, Jana Ennis asked, can you suggest or identify another example of depreciation in which you would actually benefit by putting money back in your pocket? In other words, uh, if depreciation, I think she's saying, is an accounting term, but can it somehow turn into real money?
Yes, it does because it reduces your taxable income. So it thereby reduces your taxes. I've seen so many businesses, they have assets and they don't depreciate them. So they just show the value on first of all, they show the value on the balance sheet incorrectly because it's the same value month after month after month. They're not, at least from an accounting standpoint. So when you go pay your taxes, you pay your taxes based upon your net profit after, I'm sorry, your revenue after expenses. One expense is depreciation. It's a non-cash expense. So you don't pay any money out of your pocket. It reduces your income, thereby reducing the amount of tax you pay. So consider it this way: the amount of tax that is reduced is money back into your pocket. I hope that answers it.
That's it.
Okay.
Terrific. Well, thank you very much, Rich,
Yeah.
for a very informative webinar, and Dave for hosting.
Thank you.
And I'm just going to plug April 9th at noon. Sign up for QuickBooks, which is a system to track some of these expenses. But thank you both very much, and thank you all for attending.
Thank you, guys.
Thank you, Rich.
Well,
Nice to see you. Bye bye now.
it's nice to see you. Thank you very much, Dave. Way to
Bye-bye.
go. Thank you.